Okay, I think we'll go ahead and get started. Good afternoon and good morning to those on the West Coast. Thank you for joining today's webinar. I'm Jeff Richardson, Senior Vice President of Marketing at VantageScore. And today I am delighted to host the fourth in an ongoing webinar series aimed at updating and helping stakeholders in the mortgage implementation process for credit scores keep up to date and be ready for when the change occurs. We actually meet today on the heels of yet another milestone in that process, which is the delivery of the VantageScore 4.0 data set, which will be the primary focus of today's webinar. I am joined today by my colleague, Tony Hutchinson. He will cover most of the material during the webinar. Tony is a mortgage industry veteran who's really been on the front lines working with stakeholders, including FHFA, Fannie Mae, Freddie Mac, and many other stakeholders as we methodically march towards the path of implementing VantageScore 4.0 for mortgages funded through the GSEs. Before we move on, I want to share just a little bit of Tony's background. Tony serves at VantageScore as Senior Vice President of Industry and Government Relations, and he brings over 30 years of experience and a wealth of industry knowledge to his position and his role. Prior to VantageScore, he was Director of Government and Industry Relations at Freddie Mac. Prior to that, served as Senior Policy Representative for the National Association of Realtors, and before that served in several positions at Fannie Mae for over 10 years. The point is Tony is a subject matter expert in this area, and we're glad that he is on the job and leading the charge on this important change. So a quick preview of the agenda. We are going to focus most of the time on the mortgage market, including an update and some details around the historical data set that was just provided. We'll talk a little bit about how market participants have already adopted VantageScore and how lenders can actually use it in the marketplace now, and what opportunities exist to get ahead of these changes in the form of pilot programs. And we'll have Q&A at the end. To ask a question, please use the question Q&A function in the toolbar that you see on your screens. But first, I always think it's good to just provide a little bit of context about VantageScore during these webinars. So I'll share a little bit of that. We often get asked, what is our mission? What is our North Star? And our mission, as stated in the slide here in front of you, quite simply, is to be the leading credit score modeling company to deliver the most predictive, the most innovative, and the most inclusive tri-bureau models and attributes in the U.S. market. So our models can be deployed by all three credit bureaus in a very consistent and effective way, which enables lenders the ability to score more consumers with greater precision. And by adhering to those principles and that mission, we've achieved great, deep market adoption, and we're growing at a very rapid rate. We call this our leaderboard, and you can see since VantageScore has been in business for the past 15 years, we now have 8 of the top 10 largest banks in the United States using VantageScore in one or more of their lines of business. And we measure our market adoption on an annual basis. And in 2023, we saw that market adoption grow 42%. We grew 30% prior to that. And the baseline for that growth is quite large. So when we looked at all of the scores used in 2023, we saw that there were 27 billion VantageScore credit scores used by market participants. One of the things we're extremely proud of is our ability to score more people and provide transparency to those consumers around their score. So we're very focused on being attentive to the needs of consumers, and actually 220 million consumers have free access to their VantageScore credit scores. We're also very active in the asset-backed security market. That's been an area that we focused on quite intensely. Billions of dollars in transactions of ABS issuance are in the marketplace now, and we expect that to grow. And lastly, we've really invested in a lot of our digital tools, one of which is a tool called Credit Gauge. Credit Gauge helps market participants gauge how consumers are doing with their credit accounts and their credit health at a macro level, at a national level. And what we see is 90% of the largest financial institutions are now using that tool in their businesses as well. So it's been a great year of traction for VantageScore. And this is the mortgage implementation is sort of the next chapter in that growth. And of course, these things don't really happen by accident. VantageScore was introduced in 2006 as a competitor to the incumbent credit score model provider. And we focused our strategy on competition and innovation. And many of the things that we pioneered are now standardized in the credit scoring industry. Things like the use of alternative data, rent, teleco, and utility payments, when that information's in the file. And the impact of that is that we can score more people more accurately. Our data scientists have also pioneered many new techniques, including using trended data, which is used in VantageScore 4.0. And when there's limited credit history around a consumer, pioneering machine learning techniques to enhance the predictive value of the score assigned to that population. So we also try to lead in terms of transparency and model governance. We're the only credit scoring model company that releases to the public our performance assessments. And so that type of transparency provides market participants the necessary documentation from a model governance standpoint. And we've always done that, and we're always aiming to be best in class when it comes to transparency with lenders and transparency with consumers. We score 33 million more consumers that left out by conventional models. That's one of the primary drivers why FHFA has selected VantageScore for use. And we're always focused on what is and isn't predictive. And so we did remove medical collection information from our models a couple of years ago to eliminate an unpredictable barrier to credit. Now, so that concludes the overview of VantageScore. What we'll focus on now is an update on where we are in the implementation plan for VantageScore 4.0. And Tony is going to take us the rest of the way through. Over to you, Tony.
Thanks, Jeff. I appreciate that. And I appreciate everybody taking the time out today to meet with us to hear about the release of the historical data set, get up to speed on that, and then discuss opportunities that are available to you all to start the process of getting yourselves prepared for the implementation of the new score come Q4 of 2025. So you can go to the next slide. Thank you, Jeff. So what's just happened, and why is that so important? Well, last Thursday, July 11th, Fannie Mae and Freddie Mac released a loan level data set that contained VantageScore 4.0 for a number of different loans. In the Fannie Mae data set, it was 25 million loans. In the Freddie Mac data set, it was 20 million loans. And each of those loans received a VantageScore from each of the credit reporting companies. Now, why is that important? That is important because it gives the industry an opportunity to see what does the score look like compared to the current score that's out there, and shows you how the GSEs are planning to come up with a representative score. So, and we'll talk about that in a few minutes because we'll take a look at what the data set has. But this is ultimately giving each and every market participant a chance to see what the new score will look like, to see what the GSEs are proposing physically in terms of calculating a representative score. So it's no longer something that they're telling you this is how it's going to look. You get to see what it looks like. And now you get to do your own analysis internally. That is a huge step because it allows you to begin to think about how this change is going to implement your business. How is this change going to potentially impact consumers? And what do you need to do in order to prepare yourselves for it? So you now have the data to do that. That's why this is such an important step. You can go to the next slide. So what is it that you're actually going to get in this data set? Well, the first thing, I told you the number of files that you're going to be able to access, and that's a huge number of files. The one thing that FHFA and Fannie Mae and Freddie Mac have reminded us, and they did this during the stakeholder forum, is that this file is not going to be accessible via Excel. So you're going to need some data analytics file program in order to really be able to import the information and robustly analyze it. But what are you going to get? You're going to get 10 years worth of loan level data from each of the GSEs. Effectively, you're getting data from 2013 to 2023. And the data that you're getting will be loans that were applied for and then originated somewhere from January of 2013 to December of 2022. It would be after the originations and the loans have been passed through to the GSEs that you would have those loans. So effectively, the dates for the GSEs would be April 2013 through March of 2023. That represents that January 2013 to December 2022 period. So 10 years of loan level data. For each one of those loans within that 10 years, as I mentioned, you'll get a VantageScore. And you're not going to just get the median, the tri-merge score. You're going to get the VantageScore for each of the 3 credit reporting companies. So you'll get a VantageScore for TransUnion, Equifax, and Experian. You'll then see that they are going to provide you with a number of different representative credit score calculations related to how the GSEs are contemplating utilizing the scores, including looking at their buy-merge combinations. Now, they're not going to tell you which credit scoring company has provided the score. They're going to anonymize them and call them credit score A, B, or C, and then give you the combinations. But again, this gives you the opportunity to physically see what those calculations will look like, or what the calculations they're proposing will look like, so that you will now be able to do your own calculation with your own data sets. Thirdly, and most importantly, this data set, the Freddie Mac and the Fannie Mae data sets, will be able to link with existing Fannie Mae and Freddie Mac mortgage-backed security disclosure data sets and credit risk transfer data sets. And that's so that they can provide you more robust performance information for each one of the loans within the loan level data set. So it is an enormous data set. For the folks out there who are in charge of credit risk for your companies, if you have credit risk models that you're building, this should give you the foundation to do the analysis necessary to start adjusting your credit risk models to prepare for bringing the new credit score model, in this instance, VantageScore 4.0, into your credit risk algorithm. The one thing that I've been telling a lot of folks is this data set is huge. It absolutely is, but it will not encompass every loan that your companies do personally. Loans that you still have on your book, loans that you have not sold to the GSEs. So there'll still be some work that each one of you will need to do in order to fully get practical experience with the VantageScore 4.0, but this is a great first step. Let's take a look at what those files are going to look like. that you'll be able to access. And over the next 2 slides, I'm going to share with you, and this is from the stakeholder presentation. So if you all were at the stakeholder presentations, you will see these files. If you were not, I'm providing these so you can see what type of information is going to be provided in the actual file that will be presented to each and every, that'll be available to you. I was looking at a answer question. I'll get to that in a second, I believe. So what you're going to see is that for each borrower, you're going to get, as I mentioned, a VantageScore, and then you're going to begin the different calculation paths. The current tri-merge path, and then an average, which has been contemplated, that has been something that if you take a look at the migration playbooks on both GSE pages, they talk about how they want to use the new scores in tandem and how they feel that they need to be able to come up with a representative score. For VantageScore 4.0, you're seeing what that looks like in real time now. You get to see what a median score looks like, the traditional median. You get to see what an average score would look like if they move to average. You get to see what those combinations of bi-merge on the average will look like. And you see how they've done that for both a borrower and co-borrower. And then the mingling of the two when they have to come up with one score for the loan. For more detail on those representations, I would say go to the migration playbooks. The other thing, and this is where getting into the data and working with it is important. FHFA has been very open about wanting feedback from the industry on the change going forward. This is an opportunity, now that you have data in hand, to share with them your thoughts on their proposals to go with either medians, averages, or lowests of scores. That is one of the things that they have desperately wanted. And now that the information is out there, that is something that everyone can do. On this page, the thing that is of interest, and I want you guys to really take away from this, is the fact that there is a connective score in the loan level data set, a unique identifier for each loan that will be used to connect with these other 2 data sets, the credit risk transfer data set and the MBS disclosures data set. And again, that is going to provide you with more robust information for your analysis. So not just the loan level score information, but now how is that loan performing? You can now see how the new score, both representative and in its raw value, are predictive for those data sets. Again, this is where the rubber meets the road for everyone. That's why it's a major milestone. FHFA moved this up on their timetable. Initially, this was supposed to be released first quarter of 2025, but they moved it up the timetable because everyone in the industry was asking about data. They were asking to have real live information in hand so that they can conduct their analysis. Now, before I move on, yes, these are originated scores, not updated scores. That's in credits. That's true. Look, is there a reason only the average of averages new approach is provided for bi-mergers? It still hasn't been determined that this is the ultimate approach to be used. A lot of the information related to the calculations of the scores You're right. They're still under consideration by the GSEs. This is what they've put out in their migration playbooks. I would indicate that, again, this is why with the information that's out there, take a look at the data that's there. See how the data performs and how it is, how you're able to utilize it in your risk models. If it is what you need, if there is an issue, let them know. That's why they have not promulgated the rules yet. A lot of questions that we get from both stakeholders in the industry, as well as folks outside of the industry, and this would be consumer advocates and others, when are the GSEs going to promulgate their new rules? I would tell you that they are working as hard as possible to get those new rules out to the marketplace. And they're continuing to do that. But they're not done. And they're still looking for input. And this would be a great time to share some of the input. There are a couple of other questions on there. I will try to get to those in a minute. One of the last questions that popped up is, will this presentation be available to attendees? I believe that we will be able to make this available to attendees. If it's not available via a link, you can always reach out to me, Tony Hutchinson, at tony@VantageScore.com, and I will make sure that you're able to get the presentation. So where we are in the timeline is we've had the data set published from VantageScore 4.0. There are a number of other key milestones that we're waiting to get to. FHFA has indicated that we're well on our way to those. They're still working to get us there. I believe that when the next set of data comes out, that'll actually add more accelerant to the analytic fire that VantageScore 4.0 has already put out in the marketplace in terms of climbing some of these milestones for the timeline. But again, this is important because it now allows everyone in the industry to take a look at the data and to begin to conduct their own analysis, see what the performance looks like. And then now that you have some concrete information, begin to share your thoughts with both the GSEs and FHFA so that this process can continue forward. One of the things that a lot of folks have talked about is the need to ensure that the process moves forward, and that as we run into obstacles, that we begin to solution those obstacles and not create obstacles or push back the timeline because we have so many questions that are unanswered. We now have information. We can now come up with some legitimate, substantial questions and begin to solution those together. And together that will help us solve them and then continue to move forward. So before I move on to early adopters, I will let you know both files are on each of the GSE migration playbooks. If you go to Freddie Mac's webpage, their web address would be under single family on FreddieMac.com, and you can go to their credit score model page. It'll be somewhat similar to Fannie Mae, and I'll talk about them in a second. But what you'll do is you'll go to the right side, the gray box area on that page, under historical credit score data. And there are a number of links that will give you access to that data. There is a guide for its use. There is an FAQ. There are disclaimers. There are conditions and terms for use that you do have to click through in order to get access to the historical data set. That is on the Freddie Mac page. Fannie Mae has a similar page under single family, FannieMae.com. It is under their originating and underwriting subcategory. And the page, again, similar to Freddie Mac, is called Credit Score Models. On the Fannie Mae page, you just need to go over to just to the right of the blue box there is a not a drop down, but there is a category called access to historical credit scores. When you click on that, it also takes you through the same process that you have with Freddie Mac. On the Fannie Mae side, you have to register and click through a disclosure, and then you are able to gain access to the scores. So again, the data is on the Freddie Mac and Fannie Mae webpage. They both give you access to the same data set. So you don't have to go to get Fannie Mae to get Fannie Mae, or Freddie Mac to get Freddie Mac. You can go to both. You can go to one or the other, and you'll have access to the data set. Any questions about that? There was one other question in here that talked about how solid we were, that Q4 2025 is still going to be the end date or the start date for the utilization of the scores. FHFA has indicated that that is what they are working for. So we look at that as if it is a solid stake in the ground. They have not indicated any timeline for moving it back. They have said that if they run into obstacles and things need to be adjusted, then yes, they would. But the one thing they've tried to reiterate to the industry is that they want to ensure that we start the process and come up with legitimate obstacles to solution. And if those legitimate obstacles cause a problem, then yes, we will look to adjust the timeline. But until we find those, then no, we're continuing to work towards this. And that's why it's important that this information be out there, which was at the request of the industry, and why it's important that everyone right now begin to really utilize the data that's there, both the historical data sets that are out there so that you become familiar with the score and begin to update your credit risk models. But two, and this is where we're going to start talking a little bit about beginning to use the data a little bit, or beginning to use the score right now in your current business so that you get the practical knowledge of the benefits of VantageScore 4.0 in the mortgage market. And we've had some early adopters of VantageScore 4.0 for mortgages already, and we'll share a couple of those with you. So earlier this year, in February of this year, the San Francisco Federal Home Loan Bank announced that their members could pledge mortgage collateral to the bank with a VantageScore 4.0. That's not in combination with any other score. That is just a VantageScore 4.0. So if they originated a loan, or they had one on the books and they needed to refresh, they could do that with a VantageScore 4.0 and then pledge that mortgage collateral to the bank. Now, why is this important? One of the things that has come up a lot is that medium and smaller lenders don't want to be left behind on day one of the new credit score implementation. A lot of them were hoping for a tiered implementation process where you begin to pull the scores now, and there's an opportunity to work out all of the internal plumbing for themselves, and then work on being able to communicate and distribute the loans, if they wanted to, on a flow basis to the GSEs. That has been pushed back to TBD. But steps like this, where a federal home loan bank allows for the collateral to be pledged, now these lenders who are members of the federal home loan bank system have the ability to bring in the score now. What does that do? That allows each of those lenders to determine, can my credit score provider provide me with VantageScore? Does my system have the capacity to bring the score in? Now that I know that, do I have the capacity to be able to deliver it out? And they're able to have this practice with the Federal Home Loan Bank of San Francisco. And that is great. And so you know, the Federal Home Loan Bank of San Francisco has been a very big advocate for us. Next slide, please. Not only have they gone out and pushed the use of VantageScore 4.0 to their membership, for a number of reasons. One, because they saw the value in a more inclusive score. They saw the value in scoring more constituents in their community. They saw the value of the predictive nature. But they saw the benefit for themselves. but they also know that there is a benefit that the rest of the federal home loan bank system would be able to take advantage of by utilizing VantageScore 4.0. Late in the spring of this year, they got in front of their chief risk officers and shared their process for authorization. They shared their process for analyzing VantageScore. And from that, numerous federal home loan banks have begun the process of determining how they can have their members utilize VantageScore 4.0 right now for pledged mortgage collateral. And the second bank, federal home loan bank, to do so, and you can go to the next slide now, Jeff, it is Chicago. And just 2 days before the historical data set was released on the 9th, the Chicago Federal Home Loan Bank indicated to its members that they can now pledge mortgage collateral to the bank with a VantageScore 4.0. Again, they were thinking the same thing that San Francisco was. We want to expand opportunity for people in our footprint. We want a more predictive use of a more predictive score. But most importantly, as this migration in the conventional conforming market has begun, they want to make sure that their members are prepared, that their members have practical experience with the score, both getting it in and being able to transmit the information out. Very, very big steps that we've had to this point. Before I move on, the one thing I would say I want to share, because this comes up with a number of questions that we get all the time, and it's always related to pricing. The one thing that we do not control, VantageScore does not control the pricing. We do not set our pricing. We provide the algorithm that creates the score. That is all we do. We are a monolithic company in that manner, meaning that is all we're responsible for. We build the score. We keep improving on the score. We do everything necessary to make sure that the score remains robust and the most predictive score in the marketplace. And we're owned equally by the 3 credit reporting companies, TransUnion, Equifax, and Experian. They are our partners. We license back the algorithm to them, and they, through their distribution channels, sell the score. So if you want information on pricing, on VantageScore pricing, you talk to the credit reporting companies, and they will share that pricing with you. If you are going through a third party, someone like a Factual Data or a Xactus or a CoreLogic, they'll be able to offer you pricing as well, because they also have the ability to sell our score to you through their system so that you can have it. But that is the way you would get at that. We do not control the score. Next slide. So a lot has been going on, and one of the big questions that comes out of all this is great. We understand the predictive nature. We know that FHFA is looking for ways to modernize the GSEs. Everybody coming out of the Great Recession and the financial crisis are looking to put systems in place, specifically newer systems in place that are able to help mitigate risk. In our instance, it's not just to mitigate risk and help the GSEs operate safe and sound, but open the door to more credit-worthy borrowers using more predictive information to determine whether or not a consumer has the ability to repay, and to be able to get deeper into some of into the files so that we can score, and effectively the market can outreach to people who have been invisible to credit to this point. So what does that really look like? Based on our analysis of the 33 million more people that we're scoring. So we're now scoring about 94% of the credit scorable population is being scored. And our goal is not just to have 94%, we want 100%. Doesn't mean all of those people are credit worthy. Doesn't mean all of those people are mortgage worthy. It just means they're now scored which gives them the choice of how they want to work in the financial market space. If their score is below the requisite score needed for a mortgage, they could decide to still try to pursue that, and they would be able to they would know that they would be getting a price that might not be what the average consumer gets, but that's their decision because they know their score. Or you have a number of people, about 13 million out of that 33 million, who have a credit score that is greater than 620, and they would not have known that. And that puts them on the path to get some better pricing and just to really be considered for a mortgage. We think that 13 million translates into about 2.7 million additional mortgages in the marketplace. Effectively, $1 trillion more of annual volume. That's why it's imperative that the new scores get added to the marketplace. Auto, credit card, personal loans have already taken advantage of the technology. They've already taken advantage of the additional loan attributes that the consumers are being scored against to determine their creditworthiness. Now, recognize that those are different products. But now is an opportunity for mortgages to take advantage of that more robust data set to help build its pipeline of potential borrowers over the next number of years. Next slide. So how can you guys begin to operate or begin to take advantage of this? I've touched on a little bit of it. We'll go to the next slide. And this is where I think it's really, really important for the folks on the line to work internally to determine how to bring in the new scores in-house so that you have them at your fingertips and you can do your analysis. Yes, there is a large data set out there that you can analyze. You've got loan level data from the GSEs. You can merge that with the CRT and the disclosure information to see how those loans have performed over time. You can see what that looks like. But you're right, that is at origination, the scores that you've got. For you, with data sets in-house, specifically if you've got portfolioed product, or even if you've got something that you want to test out that you're sending to people outside of the conventional conforming space, now is a chance to bring in VantageScore, do a deep dive on it, analyze how it scores more folks than you may have in the past. Take a look at those applications that have been thrown out because of lack of score, or potentially have been thrown out because their scores were low. If you analyze them with Vantage, you might see that some scores have gone up. You may also see that some of the loans that you approved may have scores that go down. But this will give you an opportunity to go through and see what does that look like. And you don't have to do it on a large portion of your book. Why is that important? Because again, it accomplishes a number of the goals that the Federal Home Loan Bank System is trying to do for some of their members. Can I get the VantageScore in-house? Can my existing LOS bring it in and house it? After I've got it housed, can I transmit it? And if I can't do any of those, I need to now put in place the processes to either upgrade my systems or patch my systems, whatever is necessary, so that it can happen. Because again, Q4 2025 is about 14 months away. So we want to make sure that we are ready, that everybody in the mortgage market is ready for that. I don't know if you guys remember the transition from LIBOR to SOFR, but as we got closer, what you found was that there were a number of institutions that just weren't ready. So you had to eventually kick the implementation down the road. Now that didn't bode well, because if LIBOR had just gone away, then those companies that were not prepared would have been out of luck until they got themselves up to speed. As it happened, they were able to stave that off until the majority of the industry was ready to go. We don't want to see the same thing happen in the mortgage market where people are not prepared. So we would like to have them as prepared as possible. So one of the other things you can do is, we talked about bringing the score in. You can append it to a portfolio that you have, special purpose credit program, manufactured housing, if you want to take a look at that. If you've got some special product that you are not, again, sharing with the conventional conforming market, maybe a product that you are just passing on to a select group of investors, you could bring the score in, begin to see how it impacts that business. One of the things that we're extremely excited about is you can actually build a Veterans Administration loan package with a VantageScore 4.0 right now. The Veterans Administration does not specify which score to use. In fact, they have gone out of their way to indicate that the score, that they're looking for generic credit scores. Now, they don't do any of the approvals based on credit score, but for a lot of the pricing and other processes that they have, they do require a credit score, and VantageScore can be part of that. So again, you want to begin to utilize the score live. That gives you an opportunity to test and validate, and then figure out how you need to migrate it. And if you are a business, a credit union, or a bank that utilizes VantageScore 4.0 with your auto, personal loan, and credit cards, this is a good opportunity to reach out to that side of the house to see how it's performing, and then figure out how to bring it over into your mortgage portion of your business. The one thing I will tell you is we can help you with that. If you need connections with the credit reporting companies, if you need connections with the mortgage teams there, we can connect you with each one so that you can have conversations there, should you need that. If you need to have conversations between your company and whichever company you're getting your score from, say it's a factual data, we can sit in and help you there. We've already had conversations with all of the organizations out there that provide credit scores, or the majority of them at least. So they're very up to speed on VantageScore 4.0 and should be able to provide it to you. Also, if you would like to speak with us one-on-one, so we can talk with your credit risk modelers, so we can talk with the other folks that do portfolio analysis in shop, we can do that. And we're not just willing to talk to you at a very high level. If you want to speak with our modelers so that you can come to better grips with how the model works, we're willing to let you speak with our modelers and get under the hood, if you will, and kick the tires on the model. Understand exactly how many attributes go into the calculation. What does our process for calculating a score look like? How do we do it? Is it similar to our competitor, or is it different? And I would say it's very different, and our attributes are different. And that's why this gets at a question that comes up a lot. Do credit scores along our spectrum, which is the same spectrum as our competitor, Fair Isaacs, do they mean the same thing? The answer is no. A 700 for us is different from a 700 for other models. A tool that you can use, and Jeff mentioned this, that we have digital tools. He mentioned Credit Gauge to you. A tool that you may want to take a look at is called Risk Ratio. It is free. You can go to VantageScore.com. Once you get to the page, there will be a blue button at the top of the right of the page that says Digital Tools. If you click on that, there will be a drop down, and one of the items in the drop down is Risk Ratio. You can click on Risk Ratio, and Risk Ratio will show you the delinquency rate by vintage of VantageScore for different product types: credit cards, auto, mortgages, and personal loans. So you'll see how a VantageScore performs over time by product, by credit risk tranche. So if you want to see how a 700 VantageScore performs, or what the delinquency looks like last month or the month before, and you can go back 24 months, you can go and utilize that tool. And again, it is for free on our webpage. I think with that, I've looked, let me continue to look over some of the questions. There are some questions that I'm going to have to pull together. There are no jumbo market statistics versus conforming models. Again, that will be up for the jumbo marketplace to conduct that analysis. But one of the things that's available to the jumbo market right now is they could utilize a VantageScore 4.0. The only thing that would preclude them from doing that is if they have some agreement with someone on the capital market side, an investor side, that says no, they won't accept it. But I will tell you this, and this gets back to the point that Jeff made prior to my portion of the conversation, and that is our participation in the asset-backed security space has been growing exponentially. Last year, we did 11.5 billion in total assets that utilize a VantageScore. The year before, it was about 10 billion. As of the first 5 months of this year, we're at 7 billion. So we're continuing to be adopted in the asset-backed security space, which means investors are becoming extremely familiar and accepting of VantageScore 4.0, and that is significant. The mortgage market will be more accelerant on that because every RMBS from the conventional conforming space, the moment day one occurs, is going to have a VantageScore 4.0. Finally, and I will wrap things up here. I know we have about 10 minutes to go. I've gone through most of the questions in the question box. The ones that I haven't gotten to, I will answer, and we will place those in our FAQ section on our mortgage page. I'll make a pledge to do that for you. So if you can check back early next week, or maybe by week's end, Friday, I will try to have those updated with the answers to some of the questions I have not gotten to. This is one that is extremely important. If you would like to arrange a meeting with our modelers, again, it's the same way that you would reach out if you have additional questions for me. It is Tony, Tony, at VantageScore.com. Simple as that. Send me your request. If you are interested in us setting up a meeting to speak with your modelers so they can kick the tires on VantageScore 4.0, we can easily do that, and we're more than willing to set that up. Just reach out to us direct. And yes, the files on Fannie Mae and Freddie Mac's webpage are the exact same format. They've tried to make it as simple and easy as possible for everyone to utilize. With that, I'm going to thank you for listening. I know that we have a survey that will come up. We hope that the information that we shared was extremely informative. Please let us know if it was or if it was not. We try to provide as much information as we can to the marketplace. There are a lot of questions that are still unanswered, but as we come up with the answers, or as we get them, we want to make sure that as many people out there are getting access to them as possible. We recognize that some folks don't have an opportunity to sit in on the stakeholder forums. So we want to use this platform as an opportunity to share some of the information that comes out of that. We also use this platform as an opportunity to, from time to time, update the industry on occurrences at VantageScore and try to keep people up to date on the changes that are occurring with us. So please continue to check back with us to see what is out there. And yes, the webinar has been recorded, and we will be placing that out on the website for people to review. With that, I'll thank you for participating. I hope you all have a great Tuesday. And again, if you have any questions outside of this, Tony at VantageScore.com. Thank you so much.